Can you please explain the difference between a 1099er and a W-2 employee in terms of taxes?
So individuals that receive a 1099, you're basically what we call a subcontractor. There is an individual that you are working for that will give you what we call now a 1099 NEC. And that is the piece of paper that you would take to your tax person, and they will prepare your taxes based on that. At this point, you are responsible for your own taxes. Now, a W-2 this is what you get from your employer. They automatically take out your taxes for you. Now, the flip side is you have to fill out a W-4, which what that stands for withholding. That W-4 stands for withholding your federal taxes. When you fill that out, you allow your employer to take out what you say take out. And that is based on the number of exemptions. Individuals make a mistake when they up down W-4 exemptions. The employer takes out less taxes. You will bring home more money. But when you lower your exemption, you bring home less money. If you are single, you want to either leave it at 0 or 1.
We as self-employed entrepreneurs, we don't know all the nuances. And when I first started using you, as I mentioned before, I didn't get the deductions. My studio here, because I use my studio as part of my business, I get to deduct this part from my house and put that towards a deduction on my tax statement. But a lot of people who have home businesses, you are allowed to use that portion of your home that you are using for your business. But I must say that home cannot be your living room. It cannot be your dining room. If Internal Revenue Service ever did an audit and you're doing business in your home and you're eating in the dining room and that is your business, you will get dinged on that. A business in your home has to have a closed door. It has to have its own office space. And how that works with the home deduction, there's a form 8829 that is filled out. And what that does is we take the square footage of your home. So if you had a 10 by 10 office, that's 100 square feet. And that is divided into the total square footage of the home. So all of your expenses is based on the percentage of that office space. So your real estate taxes, your mortgage interest, your mortgage payments, your utilities, all of that is pushed into that office space of your home. What's not used get dumped on your Schedule A, which is an itemized deduction form. We have a question from the stage. This is from Leader of the Pack. He says, I am a 50-year-old W-2 worker. I am confused on which is the best for me to contribute to max out my 401k to offset tax deductions, or focus on ready cash with a Roth 401k.
Okay, Leader of the Pack, my question would be to you. Everything in the tax system is based on your income. Okay, a Roth is you pay tax going into that. So when you take out, you are not taxed going out. So let's say like you had a Roth IRA and you wanted to purchase your first home. You're not going to be taxed on that coming out. But if you had a traditional IRA, you will be taxed on that coming out. Now, if you're not 59 and a half years old, you're going to be taxed on an additional 10%. So I tell anyone that is taking out a traditional IRA from your IRA retirement, please tell them in your benefit office to take out 20% if you're 59 and a half. If you're under 59 and a half, please take out 30%. Now, maxing out is going to be based on your income.
I have a couple of questions from Ricardo Alexander. What happens if I don't file my taxes?
If you don't file your taxes, Internal Revenue Service just would do it for you. What they do, they would do what we call a straight shot. There you have your W-2 that was furnished to them from your job or jobs, and they will go straight down the line. They will give you your name, your date of birth, your full name. They will have your current address that's on that W-2. They will make you single, and they will just go straight down the line and do it for you. And I tell individuals, if you don't file your tax returns, sometimes you can lose out and the Internal Revenue Service wins. So try to file your taxes on time. And I must say also, if you're trying to buy a home, don't fall too far behind, because if you're 5 and 10 years behind in your taxes, it can be very hard to find someone to do your taxes for 10 years when you're trying to get a mortgage. A mortgage company will not touch you until your taxes are in order.
I have another question for you, Belinda, and this is from Minnie Johnson. The question is, as a new worker in my 20s, what can I do to optimize my returns?
So once again, it's based on what your filing status is, Mimi, and it's based on, do you have any dependents? It's based on if you have any contributions, any itemization. It's based on all of that. So, and it's also based on your W-4. If you're single, I tell them take it single at a higher married rate. And if you want them to take out any more money, you have to put that on you can't afford to take it out. It's sometimes the individual falls short. If you are a high income tax earner, once again, if you are able to itemize, that would help you lower your taxable income. If you have mortgage interest, real estate taxes, charitable contributions, that can help you lower your taxes also. If you want to contribute to an IRA, that would help you lower your taxable income also. But with the IRA, you have to get that in by April the 15th. And when you do that, Internal Revenue Service will receive that copy from whatever company you went to open up that IRA. If you're a high income earner. If you're single and a high income earner, you do not want to have your W-4 at a 2, 3, 4, and 5. You want to have it at least 0, and you can have additional income taken out. And you can take that up with your benefit office at the employer. If married, is it best to file jointly? That is a question that a lot of couples ask me. So sometimes it's better to file separately based on if one individual, has like a lot of income and they have like a lot going on and they don't want to have that other individual involved in their financial affairs, it's better to do that. But if the individuals feel like they want to file jointly, I don't stop them from doing that, because when you do separately, you're only going to get that single deduction. And if you do married filing jointly, you're going to get like with the deduction, you're going to get that $27,500. But at the same time, if you do separately, let's say like you own a home and both names are on the house, you have to split everything down the middle if you do married filing separately, if you have, no drama going on or anything like that. So it's based on that individual, how they want to do it. But I tell them, if they have anything going on prior to that marriage, that they don't want to bring that other spouse in to cause them to be accountable for their taxes, then it's best to do married filing separately. Okay. The leader of the pack. Oh, hello, leader of the pack again. Okay, my co-worker files exempt all year when it comes to file taxes. He pulls from his 401 to pay the taxes he did not pay. What is your thought on the way he does that? There's a special form that we use called Form 5329. And that form tells us what are you using your 401 or your pension money to pay. There are certain stipulations that you are not taxed on to use your money to pay your taxes. So leader of the pack, that co-worker is a little smart, but everyone can afford to go exempt, because everyone doesn't have a 401 either.
Here's another question from Amalika. She says, at what point do you stop claiming your children? Our daughter is graduating college and will be going full-time into the workforce. When do you stop claiming her?
It's going to be kind of funny, but I'm going to say never, because if they never get a job, you can claim them. Okay? Now, our daughter's graduating college and will be going full-time in the workforce. Now, your daughter is in college. from the age after 17, from 19 to 23, while she's in college, you can still claim her. Now, when she goes in the workforce, if her workforce is not enough to be a taxable income, you can still claim her. If she goes into the workforce and makes under $13,850, believe it or not, you can still claim her as long as she give up her exemption. Now, she may make $13,850. I'm just saying that, but hopefully she will make more than that. And let's say like they take out $600. You can claim her and she will still give up her exemption to you and her dad, and she can just get back the money that Internal Revenue Service took out of her paycheck. But two people can claim the same person. One person will have to give up that exemption in order for them to be claiming another tax return.